Hello, we're going to cover warranties and premiums on this video. And I have an example here already made up, and I have some accounts already set up so you save some time. But for the warranties, we're going to do KCD Sound Solutions cell amplifiers with a 2-year warranty. In the first year, they're expecting 5% of the sales to come back to need repair. In the second year, they're expecting 10% to come back that need repair. The average repair cost is going to be $80 per amplifier or per repair. And the sales, we're going to keep it simple in that the sales are going to happen evenly throughout the year. So in 2012, we sold 6,000 units. In 2013, we're going to sell 7,000 units. And the cost of the repairs that came in 2012 was $23,600. And $54,600 for the repairs in 2013. Okay, selling price is $250 per unit. So the first one we're going to do is just simply record the sales. So we'll equal the 6,000 units times the $250 per sale, and that gives us $1,500,000. Okay, that's just a normal sales price. But the warranty expense is what we need to work on. So for the warranty expense, we need to record it at the time of the sale. So the warranty expense will equal the number of units sold times the $80 times, now here's where we have to add them up. The 5% for the first year plus the 10% for the second year, for a total of 15% will be coming back, or $72,000 of warranty expense, and that's going to equal $72,000 there as well. Okay, so your journal entry for that would be warranty expense and then credit estimated liability under warranties, or something to that effect, depends what book you're using. Now this entry is to record the actual warranty cost that we had for the year, which is $23,600. And you notice down here, I already have down here, I have the journal entries going in for me already, so I don't have to mess with it. That's my little T account. Okay, so this is what we did in 2012. This is to record the sale here, and this is to record the estimated warranty expense and liability that we're going to have based on those sales. And this entry is to record the actual amount that we paid. Okay, as well as cash, supplies, etc. Okay, in 2013, we would do the 7,000 times the 250, and that gives us $1,750,000. That's to record our sales, and we do the warranty expense the same way, which would be the 7,000 this time, times the 80 for the average repair, times the 5% plus the 10%. Remember, we have both of them coming in over the 2 years because it's a 2-year warranty, and that will give us the $84,000. Okay, and then this entry is to record the actual repair we had in 2013. Now you think it's higher, but remember the 2013 is part of 2012's second year. Okay, so right now we have $77,800 in the estimated liabilities under warranty. Okay, now this is at the end of 2013. I didn't put that on here, but at the end of 2013, we still have some warranties left on 2012. Now here's gets a little tricky because the warranties we have left are remember they're happening throughout the year. There's the 2-year warranty times I want to put 10% times a half a year. And that's where it gets a little tricky. So we have equal the 6,000 units that we sold in 2012 times the $80 times the 5% times half a year, or 0.5, which is the $12,000. Okay. Now the reason why it's that entry is because we have half a year. You have to remember we sold them evenly throughout the year. So the first year is done because we sold them December 31st, 2012. On December 31st of 2013, the first year is completed. And the reason why we do a half a year is because those that we sold January 2nd of 2012 on January 2nd of 2014, which is what we'll be working on, the second year is done. So the 2012 entries will start dropping off as the year goes on. That's why it's times 1/2. And it's a 10%. Okay. For this one, we'd have equal the 7,000. This is for the first year of the sales, times the $80, times the 5%, times 0.5, and I put that into the wrong spot. That should go over there. And since I did that way, okay. And this is going to be then, let's see, the 7,000, forgot what I was doing here, times the $80, times the 0.05, well, so you don't get confused, 5% times 0.5 years, and that gives you the 14,000. And in 2014, we also have 2013 end of it. All of the sales for 2013 will have the 10%, or they'll have the entire year out there for the 10% aspect of it. So we would have equal the 7,000 times $80 times 10%, which would be 56,000 for a total of $82,000. Okay. Now, remember the first year, 2012, half of them will start dropping off as we go through, and that's where the problem is going to be at. The other one we'll have is in 2013. This is the first year. Half of the first year sales will drop off in 2013, but they'll start the second year, and that's why the entire amount's here for the second year. Now, the idea here is if you think this, we have $77,800 left in the estimated liability under warranties, and we have $82,000 that we need. If you think that's too small of a number, you can do a journal entry just for the difference. So it'd be the $4,200. If you think that's close enough, you don't have to do the adjusting entry. That's going to be a call that you have to make. But that's how you do basically with the warranties. Okay, now the other one we have is premiums, and this is going to be a CD company. Yeah, serial company. I started doing another entry here. Oops. What happened here? Okay, the next one's the premiums. We're going to have Cereal Incorporated is offering a stuffed bear with 10 box tops and $1. So that's how they're going to do this. You send in 10 box tops and $1, you get a stuffed toy bear. The company estimates that 65% of the customers will redeem the box tops, and they purchased 13,000 bears in anticipation for this. And it cost the company $1.25 per bear. Okay, to record the purchase of the bears, we would have inventory premium. And that will be equal to the 13,000 bears times the $1.25, or $16,250. I just put the lines here so I know where to put my entries at. Oops, got to have a credit, and the credit will be basically the cash, because we probably have to pay cash for it. Okay. We sold 200,000 boxes of cereal at $3.50 a box. Okay, so this is just simply going to be cash, because that's what we sold at the grocery store, basically wherever we sell them for. So we sold the 200,000 times the 350, or we sold $700,000, and then this credit will be sales. And I didn't. There we go. And that's going to be for the 700,000. That's just to record the cereal. That's just to record the sale of the cereal. The 70,000 box tops, so we received 70,000 box tops were submitted to us, and they paid us 75 cents. Oops, I got to change that up here. I forgot to change this one. I was going to start with $1, and then I went to decide I was going to make a better offer. So I'm going to do it for 75 cents. So they sent us the 75 cents and 10 box tops, and we received 70,000 box tops. So that would give us cash of what we have here. I put in here, we'd have the 70,000 box tops that we received divided by 10 times 75 cents. Okay, that's what we would have here. So equal the 70,000 divided by 10, because that's takes 10 box tops, times the 75 cents. So we receive $5,250. Then we have premium expense. This is the cost that's going to cost us to do this little thing. Well, we do the same type of thing. We'd have equal the 70,000 box tops divided by 10 times, okay, now the cost is $1.25, but we're being reimbursed 75 cents for it. So it's going to cost us $3,500, which isn't too bad for advertising. And then you credit inventory premium. So that takes it out of inventory, and again, that's going to be the equal to the 70,000 divided by 10 times $1.25, and that should equal then $87.50, and you see that equals $87.50. So everybody's happy. Okay, so that's when you receive the box tops. That's how you would do this one. Now, end of the period, because we sold 200,000 boxes during that promotional period that we have, and we expect them to, we expect 65%, so it equal to the 200,000 times the 0.65 that we have redeemed. So expect 130,000 box tops to be redeemed. You subtract off how many box tops we've had redeemed already, and then the difference is our future amount that we would have that we think is going to be redeemed, which would be, try this again, equal to the 130 minus the 270, so 60,000 box tops to be redeemed yet, which is what we would expect. Okay, the cost of the future redemptions. Okay, I don't know what that line was there for. Oh, wait, no way. And I had this already done. I was aiming to take this off. So it's 60,000. The 60,000 divided by 10 times the $1.25 minus 75 cents. That's what would go in here. Okay, so we have the 60,000 that we have expected to come in yet, divided by 10, times what our net cost is. Now the Bears cost is $1.25, but they're going to pay us 75 cents for it. So it's actually 50 cents, or $3,000. So what we have here is our journal entries, which will go here. I'm trying to think where they went. So we have premium expense, and the premium expense is the 3,000, and then we have premium liability. There we go. And that's the 3,000. Okay. And that's the premiums that you would have. Okay. So again, this is just arbitrary. They'll tell you how many we purchased, and the cost. And you do the journal entries for that. 75 cents is what they had to pay us. And so that's where the cash came from, divided by 10, because you don't get 75 cents per box top, you get 75 cents per order, and it's 10 box tops per order. And then your journal entry then would be cash, premium expense, and inventory premium. And down here, what you need to calculate here is how many is going to come in yet, and what your future cost is going to be. Okay, so that should take care of premiums.